So I thought we'd first talk about who the hell is Habito. As you're here, you may be wondering. You may have seen our aggressive campaigns, and they are related to what we have seen that customers feel when they talk about mortgages. They like not to talk about mortgages, and they like to not think about what tends to be an experience with quite a lot of jargon and time wasting. So we're set up to change that and make a broker experience, but also lending products that are better for that. That's been going rather well. We've been open for customers since April 16, and since then we've done £3.5 billion of mortgages advised. We do all of our mortgages advised, and we're for free in brokerage. Customers like that. Because we are open 24/7 for questions, and we have real humans at the end of a automated process, like those two gentlemen there. They're not 24/7, but open till very. We have brokers on hand every night, including the weekend. We're now 180 people in these offices, and the most important stat we all watch like a hawk is we get really good reviews from customers, which we think is the key. And so far it's 4.8 stars out of 5 on Trustpilot. And where we could have been accused of doctoring it in the beginning, I'm sure we didn't. But with these kind of numbers, it's starting to get hard. So maybe customers like some of it, which is great. We are the only broker that's also a lender since July last year. We always wanted to do that. We've also started making our own products. In buy-to-let, we were talking about tonight, we're going to launch residential mortgages later as well. But particularly for, not to copy what everyone else did, but saying there's a couple of segments where where it's not done well. Last thing I'll say about that, and I'll talk about rates, is what's unique about our mortgages is we're hoping everyone will copy, and then we'll think of something else. So we give clarity up front. We call it instant decision, where a decision in principle, as you get from other lenders, tends to be a bit sketchy and based on average 7 questions. We use actually all of our criteria, and we do an instant check with a number of databases, so we can get a offer that we can stick with. And you can get a offer in a few seconds, and therefore we can do the full process to offer in about half the time as everyone else. Talking about being underserved, we think there's a couple of elements, particularly in the buy-to-let market, little criteria that are just a bit weird. So there's many lenders excluding tenants on benefits, which we don't see a rational reason for, so we don't do that. We're particularly good for self-employed. We only need 1 year of history. And crucially, we have lower deposit and longer term. So we go up to 80% loan to value, and we have a lot of it is in our 7 and 10 year mortgages. We do individual, company, and portfolio buy-to-let. And the thing we're particularly proud of is we've made our terms and conditions actually something you may want to read, and if you did, you could actually understand them. And Fairer Finance, an external organisation, thinks we're the only mortgage terms and conditions that hit that mark of being understandable by people who have a mortgage. So we're pleased about that. So products stand on their own. Talk to a broker later. But let's talk about the market. So to talk about mortgages, forgive me because there will be very different groups in the room. But so some of all of you may know this, but just why is it important to even look after talk about rates? I think having a mortgage is a big part of maximizing your return as an investor. So just taking it to a simple stylized example. If you had £100,000 in cash and you put all of that into a property and bought it outright, or took a mortgage, what would that look like? Now, taking you to the numbers, if there was £100,000, you put it in, you bought that property that was £100,000, you wouldn't have a loan, and you'd get a rent that on average in the UK is somewhere between 4.5% and 5%. So we took 5% for ease of calculation. So you get £5,000 of rent in a year, and there wouldn't be a mortgage, and you need to deduct average cost of about 30% of rent to get to a net yield on the rent of £3,500 on that investment. And then, so with my block is in the way, the house price will typically agree. We've used increase, so we've used 2% a year over 5 years. That gets you to just over 10%, so £110,000 is the property. If you take 110 minus 100,000, so 10,000, and 5 times 2,500, you get to just shy of £30,000 return on your 100,000 investment, which is great on 30% over 5 years on cash. If you use leverage, if you use debt, if you use mortgage, you could bought conservatively, if you take a 66% LTV, you could buy 3 properties for 100,000 each. You take a loan of 67,000 on each of them. You'd get the same rent of 5,000, and but you need to pay the mortgage lender. We assumed a 3% interest-only mortgage, which is you can probably get a bit cheaper. It depends on your circumstances. But that is a £2,000. So you're left after costs with less profit per house than if you had cash, because you have to pay the mortgage of £1,500. The house would increase in value by the same amount, so you'd make £17,908 on a single property, but you'd have 3 of them, which means that for the same 100,000 investment, you'd get 53,000 in profit out of this, out of the same investment. So in thinking about property as an investment, you should make sure you have appropriate leverage. You should always make sure you can afford it. But the impact on your returns are massive, which is why we thought, clearly we are a mortgage institution, so we're passionate about this, but this shows why. Which is why we thought it would be interesting to talk a little bit more about this 3%, because it's a big part of the profit and loss budget that you should make. This is magic. It's amazing. You keep being quicker than I can be. So, what's going on with rates? There's a lot of feverish speculation in the papers around what is the Bank of England going to do. There are reasons to be depressed, like GDP is slowing from already a quite slow rate. So the economy is not growing that fast. They're always a bit lagged, so we'll find out on Thursday at the same time what the growth was in the month of December. It's okay, small consolation. We're doing better than some other countries, but it's not a lot. And inflation is the Bank of England is trying to keep it at 2%, and has been under that for 10 years now. Well, 5 years. So. For these 2 reasons, you would say, well, there needs to be a rate cut. But then employment is going really well. So if you look at the employment market, there's very low unemployment and a very high employment rate. So people who are looking for work are getting more of that than before. So all in all, on balance, the traders are thinking there should be a rate cut on Thursday of 25 basis points, a quarter of a percent. However, has there been a bourse bounce? Regardless of what you thought of the election result for many other reasons, for buy-to-let investing and property, the market result is fundamentally this was a great thing. So there's a lot of confidence. We are seeing, I think we're seeing 200% more inquiries than we did a year ago. Now we're a bit bigger, but that's still a massive uptake. For January not necessarily being a huge month in mortgage land. And this graph here is the Purchase Manager Index. So every month the Bank of England asks everyone who buys for companies, what do you think? Is the next month going to be better or worse? And the balance of that is an eerily accurate forecast for what's going to happen to the economy later. And you can see after a lot of malaise of what's going to happen, I think any clarity is better than not. Balance has led to a big jump up. So Bank of England may not do this and actually keep rate as it is. I personally think that's what's going to happen, but it kind of also doesn't matter that much, because for mortgage rates, 0.25% up or down doesn't matter that much in the big P&L. But also the UK is now, particularly in buy-to-let, is more than 90% fixed rate mortgages. They tend to be funded by another rate called LIBOR. So the Bank of England base rate, unless there is a huge surprise in it, isn't going to move mortgage pricing that much. There's been a longer trend of adjusting the rate to lower growth, but also very low bad debt in mortgages. So banks, building societies, specialist lenders are getting more and more confident that they can make a profit at these lower levels. These are all mortgages, not just buy-to-let, but you can see that in the last 3 years, people, which is the average time that people tend to stay on a fixed rate, so everyone who is up for remortgage tends to be 0.5% better off. So that is more than £900 on a typical buy-to-let mortgage. So remortgaging is a lot cheaper and is worth looking into when you get to it. This won't move that much if base rate goes up or down on Thursday, unless base rate goes up to much higher territory, or we start European experiments like negative base rate. I think most of the forecasts predict that it's going to move in a quarter up, quarter down band for the next 18 months at least. So it is interesting, but not that interesting to look at the Bank of England. But it is very interesting, I think, that if you look at all the rates, that the mortgage market is getting more and more competitive and more compressed in things like higher LTV versus lower LTVs, or longer term versus shorter term. Used to be much more different in price, and it's been much more compressed. One of the reasons, that is one of the reasons why last year we saw quite a big shift in the residential market, which is now happening in buy-to-let, where traditionally the UK is incredibly dominant as a 2-year fixed product. That could be partly because brokers like to be paid every 2 years, but there's also a product we all got used to. In the last year, so last 2 years, January 18, the dark blue line is 2 years, and this is the percentage of mortgages that are on 5 year. There's been a big shift from 2 years to longer term, skipping the 3-year product and straight going to 5 years. Part of that is to do that you can typically get a bigger mortgage on 5 years than you can get on shorter term in affordability. And the second and final trend is, so the third is after mortgage rates are low and then tend to be longer term, is we've seen an increase in company buy-to-let. Company buy-to-let was, so using a limited company to have your buy-to-let portfolio in, was happening at the sort of very large number of properties end of the market for years, but it was a bit niche. The tax change that George Osborne made in 2014, saying, well, you can't deduct all of your mortgage interest rates at your tax rate applicable over time, are slowly kicking in. There were many years of building that in. I think this year is the last one. And I think last year we sort of saw people really reacting to that and saying, well, this doesn't make sense. Now going for a remortgage from an individual to company it depends on the circumstances, but is unlikely to be a great idea because you need to pay stamp duty again, and indeed with a 3% surcharge. But if you're purchasing a new property, a lot of our clients are saying, well, I'll set it up as a company. So where we saw in the market 50%, so where we saw in our book 50% each way, company and individual last year, which is a massive change from I think it was 30% the year before. We're also seeing in intentions, this is a market survey, 62% are saying the next time I buy a property I'll do it in a company, which makes a lot of tax sense for quite a lot of people. So that was the 2019 trends. If we look forward, I think 2020 in many respects will look a lot like 2019 in mortgage rates. One is base rate may move a bit. We'll all get very excited about this. I'm an economist by education. We like to argue about this for months on end. but it's not going to matter that much to the rates. If there is an unexpected no-deal Brexit at the end of the year, that's a very different story, but the Bank of England itself won't be a big news in 2020 for mortgages. I do see some of those trends I just talked about continuing. So high loan to value, as they become less dear compared to lower LTV, you can see that 75-80% mortgages in buy-to-let will become, I think, cheaper as they become more popular. There'll be a bit of a war for that. So take your advantage of that. And the trend towards 5-year plus, I think, will also continue. So debatable how much of it will be on 5, but the group of 5, 7, and 10 will be bigger than it is in 2019. It's my forecast. And then I think there's been, Kate will give a more comprehensive view on this in a bit, but rent increases have been quite limited. I think in 2020 it won't be massive, but I think there is, after the estate agents, letting fees, the view we see on rent, on this tax changes being changed, I think there'll be quite a few. If there is a void, quite a few landlords will use this time to reset. So I don't see it going from 1.5% to 4%, but there'll be a bit more scope to increase rent in 2020, which may bring some of the regions, particularly London and Southwest, a little bit more in play than they've been in 2019. Where affordability, high LTV may have been great, but the affordability was hard at 2%, 2.5% yield. So for the individual investment, finding the right property so that the yield and your house price increases makes sense, it remains the key. But I think overall it will be a little bit easier in London and Southwest than it was in 2019, where it made a bit more sense to maybe invest slightly outside.